In the name of God, the most merciful, the most beneficent. And this part of this lecture is about cash management under corporate finance for CMA part 2. And this is topic 4 under working capital management. So these are the learning objectives that we'll be discussing in this part of this lecture about the factors influencing the levels of cash, motives for holding cash, and forecast of future cash flows. How do we do that? Methods of speeding up cash collection, benefits of lockbox system, and other items like banking system and other things. This is cash management overall framework, and in which we will be discussing about all these things in detail. We will be discussing about the method of speeding up cash collection, how do we do that, and we will discuss about the banking system, concentration banking and compensating banking, and types of cash flows that must be managed. What are the motives of holding cash? There are transaction motive, precautionary motive, and speculative motive, and forecast of future cash flows. Collection points, there are various collection points, that how do we manage on that, and net benefit of lockbox system. Lockbox system is one of the collection points. Disbursement float and overdraft system is what, and we will understand that, and methods of slowing down disbursements. So one side we will be talking about the speeding up of cash collection. How do we rotate the inventory more quicker to get the cash flow inside the organization? And similarly, the accounts payable payment can be, whether it can be delayed or not. So that is, we will be discussing in methods of slowing down disbursements. Cash payment, how can we disperse so that we can hold cash little delayed way so that we have cash flows. So that is the thing that we will be discussing. The factors that influence how much cash is held by a company. What are the factors that we need to keep in mind? How much cash is needed in the future, in the near future? What is the firm's risk attitude towards solvency? Whether can we have an aggressive or whether we are in conservative risk attitude. So accordingly, conservative, cash has to be sufficient level to be maintained. Aggressive means that we can take that much risk to take that when, as and when there is a requirement. What is the level of other short-term assets that the firm holds? The available return on other short-term investments. So if there is a cash flow, if we are investing, whether we have, what is the return on that? What is the opportunity cost of that cash? If cash earns a low interest rate, the opportunity cost of holding cash is reduced. However, when there is a high interest rate, the cost of holding the cash instead of other investment increases. A company may decide to hold less cash and accept higher solvency risk. That is, if higher solvency risk in return for a more interest received. So because we take that risk, because we have taken that risk, we invest that short-term cash into some returnable investment, short-term return investment. So that is the thing. If a business is a seasonal business, it will have more cash at the peak periods than at the slow period. Because in the slow period, the inventory will not be moving at much frequent speed. The business operating cycle and cash flow cycle. These are the two important measurement tools in order to measure the effective cash management and in fact the working capital management itself. The operating cycle is the number of days that inventory is held before it is sold and the number of days that accounts receivables are held before collections. It represents the total number of days the firm has funds invested in working capital. That means partly with the inventory and the accounts receivable, how it is rotated. The cash conversion cycle, also called cash flow cycle, is the operating cycle minus the average age of accounts payable. Because in the cash flow, in the cash conversion cycle, that inventory is converted into cash, and it is inventory is sometimes, most of the cases, it is converted into accounts receivable, and accounts receivable by collection converted into cash, and that cash will be again dispersed against the accounts payable. So that is why the cash cycle is comprised by the operating cycle, which is the inventory as well as the accounts receivable held before collection. So all these things minus the the disbursement of cash, that is accounts payable, average age of accounts payable. So this is how the cash cycle is computed. This represents the number of days from when the firm pays for the inventory until when it receives the cash from the sale. Shortening this cycle without affecting sales can add to the firm's profitability. Because by shortening, if you are very strict on accounts receivable and do that way, maybe sales will not be increasing. So that's why we have to balance it. A company wants to do what it can to decrease this number, and this may be done either by collecting the receivables faster or by delaying the payments of its payables. So it is one way of evaluating a company's cash management. Anyway, we will look at the different ways of doing both of these in this part of this lecture. This is an example of business operating cycle and cash flow cycle. So in this example, we study that assume that a company has an average age of inventory of 120 days, an average age of accounts payable of 100 days, and an average age of accounts receivable of 40 days. So the number of days in cash flow cycle is calculated as follows. So how do we calculate? So we take the inventory 120 days it is there, and then accounts receivable 40 days. So total become 160 days. Out of this 160 days, accounts payables are for 100 days. So the remaining will be the cash cycle, which is 60 days. So this is how we have to calculate that. In order to arrive at a way of managing the level of cash, we need to understand what are the motives of holding cash. So there are three motives of holding cash. One is the transaction motive, and precautionary motive, and speculative motive. Transaction motive is like a kind of exchange. So address the unsynchronized nature of cash flows. This is sufficient or near cash reserves are needed for meeting payments arising from ordinary business operations. Any kind of small purchases, wages paying, rent paying, taxes, dividends declared already or to be paid. So we need transactions to be executed. So we need cash for that. This is coming under transaction motive. Precautionary motive is a kind of safety requirement to provide a buffer for unexpected cash needs. Speculative motive is really for involve the use of surplus liquid reserves to take advantage of short-term investments or other temporary. So it is speculative. There is an income, there is a good return, so we invest on that. This is to take the opportunities that may arise. The price of raw material suddenly may decline and offer a substantial savings if purchased with reserve funds. So we have to take that kind of opportunity. As part of his theory of money demand, English economist John Maynard Keynes gave this theory, the three motives of holding cash. The goal of managing the cash level. So based on these motives of cash, we have to derive at this goal of managing the cash level to determine and maintain the firm's optimal cash balance. So we should not have the maximum cash also. We cannot rely on take the risk much as a minimum cash level or no cash level also. So we need to find out what is the optimal cash balance. So this is not the same as maximizing cash. Since ready cash does not earn a return, only the amount needed to satisfy current obligations are important. Striking this optimal cash balance is the essence of cash management. How do we calculate the optimal cash balance is the most important part of the strategic management decision making, especially under working capital management. So there are ways And for that, as we discussed, that the motives of holding cash and the optimal level of cash is collected. Transaction motive, the need to satisfy the three motives of holding cash must be balanced against the opportunity cost of missed investment in marketable securities. So cash or opportunity cost on marketable securities also important because they are like cash equivalents. So whether we have to retain them, hold them, or we as a cash only, or put it as marketable security so that we can get some return also. So this is also an important part of the study. One approach to solving this dilemma is to apply the economic order quantity. So there is kind of inventory management system. There is an economic order quantity. What will be the economic order quantity? So similarly, the cash management also, we can treat cash as quantity, the amount of cash as a quantity of cash inventory, like kind of thing. So there is a same formula can be applied here. The economic order quantity, in order to calculate the optimal level of holding cash to be applied. So in this apply that we need to determine how much cash will be needed over the period under study. Whatever that accounting period, whatever the duration that we study, how much cash will be needed over the period, and the cost per security transactions. That is the opportunity cost or the marketable return on investment, all these things taking together. So we get that cost per security transaction and the interest that can be earned on marketable securities in order to arrive that cost calculation. Then we apply this formula that the economic order quantity Q equal the root of 2BT divided by I. So Q, that means the optimal cash balance, and B stand for the fixed cost per transaction. What is the fixed cost of that? And T, total demand for cash for that particular period, and I, interest rate on marketable securities. So applying this formula, we get the value. For example, a firm has projected that it will need $20,000 to pay its obligations during the upcoming month. So that is that period. Every marketable security transaction involves a fee of $5, and securities are currently paying 6% annual interest. So we apply that into this formula, taking that 2 into the B is $5 multiplied by the T value, which is the total demand for cash, which is $20,000, divided by that I, that is the interest rate, which is 6% per annum. But here we are talking about 1 month only. So therefore, this is divided by 12 months. So therefore, we get that $6,324 is the economic order quantity, the cash management for that. So this is the optimal cash balance that we need to maintain. So that's how we calculate that. And with this calculation, actually the firm's optimal cash balance for the upcoming month is therefore 6,324, but we normally take the average. So what is that average is divided by 2. So that is in between, we can take that much average balance that we can maintain during that month. So this is how we calculate. Forecasting future cash flows. Forecast of future cash flow contained in a cash budget. So we prepare cash budget which is with the forecasted figures. What will be the future cash, what is the current, what was the past trend and future according to the cash flow. That provides a starting point for cash management. From this forecast only we prepare the cash management budget also. It details projected receipts and disbursements, whatever the receipts that we will be having it, and whatever the accounts payable that we need to meet, whatever the payments structure that we need to meet also have to be taken into consideration with a view to planning the synchronization of inflows and outflows, cash inflows and outflows. Specifics on building a forecast cash budget are found in annual profit plan and supporting schedules. So in every business concern, there will be an annual profit plan. So in that, this forecast will be also incorporated with appropriate supporting schedules also on which quarter, which schedule this inflow and outflow will be affecting. The forecasting techniques can be used to develop updated cash budget for current, weekly, monthly, or quarterly needs. Annual cash budget developed in the prior year will not provide the useful information that is needed because the past year is one thing, but the current year will be mainly we are concerned with the future cash flows. So that is important for that. Not by just past history alone will help that. Types of cash flows that must be maintained. So one is cash inflows and cash outflows, and in between there is a concentration flows also. So cash inflows talks about collected from customers, funds obtained from banks, lenders, whatever the funds taken from banks and other lenders, and other financial sources, and funds received from investors and other sources. All will be cash inflows coming to this company. And concentration flows, it is internal transfers among the firm's business units and in between various banks accounts the firm wants to create liquid reserves. See, for example, as part of the collection points, there may be throughout this country or worldwide, maybe various banks will be there as collection points. All funds will be mobilized to those collection points. But internally, all things will be transferred internally to one disbursement account, which is the centralized concentration account. So that is called internal transfers. And then cash outflows include the funds distributed from the firm's liquid reserves to employees, vendors, shareholders, and other payees of the company. Here is an example of cash inflow, that is the receipts. So a company has developed the following forecast for cash collections for the next 4 months. So July, August, September, October figures have been given for cash sales as well as the credit sales. So on average, 50% of credit sales are paid for in the month of sale, whatever the months, and 30% in the month after sale, and 15% in the second month after sale. So these are based on the credit terms of the company. So we get that detail. So based on this given information, how do we calculate the projected cash collections for October, for the month of October in this example? So October cash sales is, that is 70,000 cash sales. So out of this credit sale 300,000, as we saw from the 50% on that particular month, so it is 150,000. And then September credit is 30% next one, so this is 102,000. And August will be 15% of the previous, that means 2 months after, that is 15. So we take that from the August sales. So overall the total October collection will be 355,000. So this is how we have to see the projected collection of cash inflow budget or forecast. Similarly, this is cash outflow budget about the disbursements. Similar example, but here now the purchases, from these purchases, how the cash outflow is going, accordingly we have to calculate. So cash disbursement activities will be budgeted. So we take the same, like 4 months figures are given for purchases and say total sales also. Why are we given total sales? Because in this question there are certain percentage about the operating expenses are based on the following month's sales, and so that is we have to, even the payroll is projected as 10% of that particular month's sales. So therefore we have the total sales figure also given, and we have been asked for the month of October to get that projection. So similarly, so the disbursement will be 50% of purchases in the same month and 25% in each of the 2 following months. So accordingly we have to do that. So that means in the October we have to take 50% of that purchases, and 25% of September and 25% of August will be involved here. So these are the cash disbursement. And then we take the 10% of the month sales, which is for payroll projected of that particular month sale October. So that is 37,000. And then the November's sales is given because we need to calculate 20% of the following month sales is for the operating expenses spent on October. So 20% of that will be calculated, and then interest payment is about 5,000. So that total is 410,500. While the budget is for a specific period of time, cash budgeting is an ongoing cumulative activity that is re-evaluated constantly to ensure all objectives are being met. The methods of speeding up of cash collections. Because if the speed of cash collections improve, then the cash inflow will be good and the operating cycle will be the faster. A collection system is the set of banking arrangements and processing procedures used to process customer payments and gather incoming cash. It affects timing of cash inflows. That means the speeding up is done by reducing collection float. Collection float means is the duration of that collection float from the point of the raising the bill, accounts receivable, and then till that it gets cashed. So that is the float, the collection float. And it has got various, the collection flows has various parts, which we can say that mail float, that is the time between check mailed date from check received date by the payee. That means the check sent by the customer who want to pay from that day and till that check is received by the payee. That means the company who is collecting this accounts receivable or any collection point that we will be seeing it. And then there is a processing float. That means the time between payee receiving the check, that bank, maybe the pay collection bank is receiving the check and it is getting processed, or if it is an agent who is receiving or the company itself receiving, and the time it takes to get it deposited in the bank. And then after that it's getting deposited in the bank, then it is availability float. The time between when the check is deposited and account is credited with the collection funds. The period of time from when a payer puts a check in the mail until the funds are available in the payee bank is called float. That means the customer puts the check from that day onward till that actual cash is to the company's credit is done. So on behalf of this, accounts payable receipt, collection receipt. So that is the entire collection flow. So it has got three parts: mail float, processing float, and availability float. So benefit of receiving earlier cash, how quickly we receive and what is that benefit, and what is the benefit of speeding up the collection. So companies use various strategies to reduce the float time. Reducing float time means speeding up the collection process on receipts, quickly receiving cash dues, and stretch the float time on payments. That means one side that we reduce the collection float time on the accounts receivable area and stretching I mean prolonging that the delaying float time on accounts payable payments. That means delaying the payments. So this way the cash inflow can be quicker and outflow can be delayed, so that the entire cash management will be more beneficial. The quantified benefit of receiving cash earlier equal the daily cash receipts multiplied by the number of days, number of reduced float, and multiplied by opportunity cost of funds. So that is the benefit is given by the opportunity cost of funds that we generate by multiplying the daily cash receipt multiplied by days of reduced float. So this way we can calculate that. The product of the daily amount of receipts and the number of days of reduced float is the increase in the company's average cash balance. This amount is multiplied by an annual rate of return on short-term investments to arrive at the annual benefit. So that supposing if we are able to reduce by 2 days of the collection float, and what is the quantity of that amount, the daily cash receipt by 2 days, and then with that, if we calculate the rate of opportunity cost of funds from based on the expected annual rate of return, then we get the actual quantity of the benefit, the quantified benefit. Okay, let's see the speeding up the collection with an example. So company uses various strategies to reduce the float time on receipts and delaying the payments that we have seen. Now let's see with an example. The firm has $22,000 in daily cash receipts, average. Okay, the company is considering a plan that will cost nothing and will speed up collections by 2 days. So they will reduce the number of days to take collection by speed up by reducing 2 days, resulting in an annual additional $44,000 in the firm's average cash balance. So because daily 22,000 cash receipts and 2 days reducing means so 44,000 in the firm's average cash balance. So marketable securities are currently paying at 6% annually. So the benefit can be measured like 22,000 into 2, that means $44,000 multiplied by that 6% rate, that means $2,640 annually. This is how we calculate the quantified benefit. In practical terms, the benefit of any plan to expedite cash collections must exceed the cost. So if there is any cost involved in the speeding up of this collection process, maybe by adding some efforts, increasing some collections, commissions, or things like that, then that will be added to the cost also. So the cost, so the benefit must exceed the cost. So that is the idea that normally an accountant has to look forward. A firm has daily cash receipts of $150,000. A bank has offered to reduce the collection time by 2 days, increasing the firm's average cash balance by $300,000. That means 2 days of $150,000. So it is increasing the average cash balance by $300,000. The bank will charge a monthly fee of $1,250 in order to reduce this collection period. So that is why the bank will charge $1,250 as a fee, monthly fee. So money market funds are expected to average 8% during the year. So now we have to quantify the benefit. So that is 300,000 into 8% things, and with that we pay monthly fees, that is 1,250, which has to annualize it. So we multiply by 12 months, so that we get the 9,000 annual benefit, net benefit. So that's why, and it is better. This option, this proposal from the bank is beneficial. So there are, in order to improve the collection speed and things like that, there may be a lot of collection points that an organization can arrange. One is this natural choice that every organization have, that is over the counter. There may be a cash counter where they will receive cash and check, they will receive it, over the counter arrangement. Other arrangements are that through the mail, that means through the postal mail courier service, and they receive check or draft payments from the clients, customers, and electronically also they can get, that is home banking, mobile and net banking arrangement, or telecom transfer, or automatic clearing house, that means electronic alternative to checks. And Federal Reserve is the main operator of automated clearing house. So in US, Federal Reserve is the main operator. So increased reliability, efficiency and cost effectiveness are the primary benefits of automated clearing house. It also offers the capability of transferring more information about a payment than is possible on a check. In a check, you have normally the payee and signature, date, amount, and not more than that. But in the automated clearing house arrangement, there may be a lot of more information can be added in the voucher. I mean, in the electronic ticket. FedWire, that is Federal Reserve Fund Transfer System, provides a real-time method to transfer funds immediately between two financial institutions via the respective Federal Reserve Bank accounts. If the client's bank and your company's bank account, they can get this transfer quickly and it will reach your company's account also. But it is relatively expensive because bank will take some charges. And another important interesting thing is that the logbox system. It is the single most important strategy for expecting and expediting the receipt of funds. So we'll see more details. Interesting, important strategic collection points are logbox systems. A logbox system is the single most important strategy for expediting the receipts of funds. It will be quicker. How it is done? A logbox system is an arrangement between a firm and banking institution in which all deposits are received directly by the bank and immediately deposited into the firm's account. So logbox system will be globally organized in such a way that your corporate company's clients can immediately go to the nearest bank and they deposit their checks or whatever their payments. And it will be deposited and received directly by the bank and immediately deposited into the firm's corporate account. And all logbox account, in a way, by internal transfer, it will go to your disbursement account of the corporate company, one constant account. And where that all the funds will go to there, and that will be the centralized accounts. From where that company is making their own funds distribution. It ensures that the deposits are made on the date they are received, thus dramatically reducing the processing float time. So earlier we have discussed the check processing, that it will have mail float. After that it has to go to deposit to the bank, and then from there availability of funds has to go. So three kinds of floating. Now here in the logbox system, it will go directly deposited and to that account also. And depending on the location, mail float also can be reduced. So some areas where logbox system is not there, still maybe they need either electronic banking system or maybe the mail float system has to be done. But wherever that logbox system can be reached, so that will reduce the mail float also. So net benefit from logbox system can be quantified like reduction in float opportunity cost, whatever that number of days reduction and the opportunity cost, plus the reduction in internal processing cost minus logbox processing cost. So there will be a charge for the logbox system, so that also will be taken in this calculation. So that is the net benefit of a logbox system. In the banking system, so we should understand that there is a concentration banking and compensating banking. So what is mean by concentration banking? Systematically transfers deposits received from field banks or earlier we have seen logbox system. So from those banks, it will be automatically transferred internally to this concentration banking. It will be like kind of centralized disbursement bank to create centralized inventory of all liquid reserves from where the disbursement actually takes care. So this is kind of centralized banking for the corporate company. Okay, so this is where all logbox system or any other banking accounts internally gets transferred to this concentration banking, from where the actual cash flow is operated of the for the organization. So even the disbursement take care. And it is also possible based on this cash flow budget, the company also can plan for short-term credit or investment transactions needed. funds are short, they can take some short-term credit, or maybe funds are more, they can put some investment into short-term investment also. And compensating balances, that is a minimum amount that the bank requires the firm to keep in its demand account. Supposing if the bank wanted to borrow some money, if the corporate company wants to borrow from the bank may ask that, okay, put some minimum amount in the account so that the bank can claim for short-term charges and even interest or any repayment scheduled payments can be taken from this concentration balance, against which there will be no interest credit will be done. Compensating balances are non-interest bearing and are meant to compensate the bank for various services rendered, such as unlimited check writing. These funds are obviously unavailable for short-term investment and thus incur an opportunity cost. So if the corporate company wants to calculate what is the cost of that loan, so they have to not only just to take the interest amount paid on the loan, that they have to also take the market rate of return and calculate the compensating balance amount on that, so that they can get the real actual cost of that loan funds. Because one side that what they pay and another side, because they are maintaining the compensating balance and they have to take the opportunity cost of elsewhere investing that fund as per the market rate. So that is the way that we have to calculate. Okay, let's just take note of some short notes on lockbox system, concentration banking, and depository transfer check. A firm doing business nationwide, globally, the lockbox network is appropriate. These notes are useful for the students for even for their understanding, and also from the examination point of view also, that they have to take care of these notes, because it will be part of these multiple choice questions, so they can understand, catch that things. And they may say, the question may say that about the arrangement, and you have to name it what system it is, like that. The country is divided into regions according to customer population patterns. That customers means the clients. A lockbox arrangement is then established with a bank in each region. A firm employing a lockbox network will usually engage in concentration banking, because concentration banking is required, because from all lockbox banking arrangement, all the funds has to be internally transferred to this concentration banking, so that it can be getting for the corporate companies disbursement arrangement. The regional banks that provide lockbox services automatically transfer their daily collections to the firm's principal bank, where they can be used for disbursement and short-term investment. A depository transfer check, that is called short-term DTC, is often used in this context. A DTC is a non-negotiable instrument drawn on the regional bank and made payable only to the firm's account at the concentration bank. So that will be the DTC will come and it will be drawn on that concentration bank, that branch itself, or the bank only. That is the important point here. So method of slowing the cash disbursements. So earlier we have seen a method of speeding up the collections, various collection points, lockbox system including, and everything we saw that, like electronic payment system, check system, all these things, and over-the-counter arrangement and other things. Now we are the other part of that for the accounts payable. How can the management can strategically think about slowing the cash disbursements in order to take benefit of keeping the cash flow for some time. A draft. A draft is a three-party instrument in which one person, that is the drawer, orders a second person, the drawee, to pay money to a third person, the payee. See, for example, if the company wants to pay, instead of paying cash or immediately transfer fund flow like that, if they send it through a draft, so that draft not automatically will have some float. Draft sent by mail will have mail float, and then the supplier who is receiving that draft is depositing in the draft in their bank, and it will have at least 1 day, 2 day float. After that, the availability float, so that the corporate company issuing this draft is having some benefit of delaying, slowing down. So a check is the most common form of a draft. A check is an instrument payable on demand in which the drawee is a bank. Consequently, a draft can be used to delay the outflow of cash. So we explained that things. The draft can be dated on the due date of an invoice and will not be processed by the drawee until that date. But sometimes they can say, normally collectively it is said that like post-dated check, but actually it is not legally agreed that as a post-dated check, but these are the commercial arrangement. But as long as that the check, the date is there, that is like a draft demand payment only. So, but they can request the supplier to hold it till they make that arrangement. So accordingly, they put some date also. So the due date of an invoice, so sometimes invoice date is after 30 days, so they can put the draft now and after 30 days date, so that the supplier can use that to get that. Sometimes they get discounted, or sometimes they will take it on that date also. It is a different arrangement. So a draft can be dated on the due date of an invoice and will not be processed by the drawee until that date, thereby eliminating the necessity of writing a check earlier than the due date or using an electronic fund transfer. Thus, the outflow is delayed until the check clears the drawee bank. So this is an arrangement. Another arrangement is a payable through draft. That is the through draft, but it is differing from the check. So that means that maybe a post-dated check kind of things, it is the payable through draft allows a firm to maintain low cash balances. The drawback are that vendors obviously prefer to receive an instrument that will be paid on demand, and banks generally impose higher processing charges for payable through drafts. So that means if the checks are not on demand, so normally the banks will charge little more to keep those payable through drafts in their custody until it is getting cleared. So that also another kind of arrangement. And payable through drafts are not payable on demand like a normal demand thing. And drawee is the payer, not a bank. So these things cannot be done on a bank draft because payable through draft is maybe the drawee themselves throw the check or they do that kind of things. And they cannot be a bank. After the payee presents the payable through draft to a bank, the bank in turn presents it to the issuer. The issuer then must deposit sufficient funds to cover that payable through draft. And normally, if there can be a zero balance account and there is a disbursement float, that also a kind of slowing the cash disbursement. So we will see that in detail. A zero balance account that carries the name implies a balance of zero. At the end of each processing day, the bank transfers just enough from the firm's master account to cover all checks presented against the zero balance account that day. See, normally in a banking account, if there is a funds, normally in these kind of funds, the bank will not pay interest. So instead of that, what they do, they keep all the funds in the accounts where they can gain some interest. But the disbursement account will be maintained at zero, but each day when there is a bank transfers, when there is a master account need to cover some checks presented against that zero balance account that day. So from that master account, there will be some funds transferred to this account. This practice allows the firm to maintain higher balances in the master account from which short-term investments can be made. The bank generally charges a fee for this service. Another way of slowing down the cash disbursement is the disbursement float. That is the period of time from when the payer puts a check in the mail until the funds are deducted from the payer's account. It is exactly the reversal of the corporate treatment on the customers of corporate treatment on the accounts receivable item by way of draft and things like that. In an effort to stretch disbursement float, a firm may mail checks to its vendors while being unsure that sufficient funds will be available to cover them all. For these situations, some banks offer overdraft protection. Sometimes banks offer the overdraft protection. Company corporate will take that. So they will keep that accounts as and when the draft is presented for payment. So the overdraft facility will be used to honor that check. So that is how these things are done. CMA adopted multiple choice question. If the and there are points, if the average age of inventory is 90 days, if the average age of accounts payable is 60 days, and the average age of accounts receivable is 65 days. So naturally we have to calculate the cash flow cycle. So we know that cash flow cycle is operating cycle minus the number of days in accounts payable. So that is the formula. So let's see this formula. The cash flow cycle is calculated as the days in inventory plus days in receivable. That is the operating cycle minus the days in payables. So all these three things are given. So by replacing it, we get that 90 days, that is inventory days in, and 65 days, that is in accounts receivable, minus the 60 days, that is in accounts payable. So we get 95 days, that is the cash cycle. Next question. SMS is a retail mail order firm that currently uses a central collection system that requires all checks to be sent to its Boston headquarters. An average of 5 days is required for mailed checks to be received, 4 days for SMS to process them, and 1.5 days for the checks to clear through its bank. So a proposed lockbox system would reduce the mail from processing time to 3 days and the check clearing time to 1 day. So instead of 5 days, it will be reduced to 3 days. So there will be 2 days saved, and the check clearing time, instead of the checks clearing time, instead of 1.5 days, it will become 1 day. So SMS has an advantage as an average daily collection of $100,000. If SMS adopts the lockbox system, its average cash balance would increase by how much that? We know that advantage. Now we have to see the quantification of that advantage. How much its average cash balance would increase by. How do we calculate? If SMS were to adopt this new lockbox system, it will reduce the number of days required to receive cash from 10.5 days. How 10.5 days comes? It is the 5 days of the average for mailed checks to be received and 4 days for SMS to process them. That means 9 days, and 1.5 days for the checks to be cleared. So total 10.5 days, 10.5 days, which will be reduced to just 4 days only, because the process time, because the lockbox system process time is 3 days plus clearing time 1 day, so total 4 days. So the 10.5 days reduced to just 4 days. This means that it will get cash of 6.5 days time faster. So that $100,000 is speed up. That's multiplied by the speed of 6.5 days. That means $650,000 more in its average cash balance as a result of lockbox system. So this is the answer. Next question. A firm has daily cash receipts of $200,000. A commercial bank has offered to reduce the collection time by 3 days. The bank requires a monthly fee of $4,000. Now we have one side that reducing by 3 days, so we have to quantify the benefit, but there is a cost which is $4,000 for providing this service. If money market rates will average 12% during the year, the additional annual income or loss of having the service is to be calculated. In response to this, the following: if the company collects $200,000 as given in the question per day, and the new collection system will reduce collection by 3 days, that means it is the speed, it has to be multiplied, so it will become $600,000 more in its bank account than currently it is having, which is whatever that 200,000 for example. This will earn interest each day because the interest rate, average rate of interest is given 12% during the year. So by taking that, so we calculate that it is coming to 72,000 in interest income per year. But it needs to pay $4,000 per month. So you have to always annualize that expense also. So if you take for 12 months, it will become $48,000. So from $72,000 minus $48,000, we get the net benefit amount of $24,000 to the company each year. So that is the additional annual income having that service. Next question. T Toys is a retailer operating in several cities. The individual store managers deposit daily collections at a local bank in a non-interest bearing check account. So those checking account has no interest bearing. So it will be a twice per week the local bank issues a depository transfer check, that is DTC, that is in order to move that funds to the concentration banking, to the central bank at headquarters. Central bank means not the country-wide central bank, it is the central bank of the corporate company at the headquarters. That is the concentration where the account is maintained, where the disbursement account is maintained. The controller of the company is considering using a wire transfer instead. Instead of that, they are considering the wire transfer. The additional cost of each transfer would be $25. Wire transfer normally the bank charges, that is for each transfer $25, but it will be faster. Immediately it reach the account in the bank. So collection would be accelerated by 2 days. So because of that, it will be accelerated, but the speed will be increased. So that 2 days savings will be there. And the annual interest rate paid by the central bank is 7.2. That means the annual expected rate of return, we can see, keep it like that. So paid by the central bank. So that comes to 0.02 per day. At what amount of dollars transfer would it be economically feasible to use a wire transfer instead of the DTC? So 360 days a year. Normally, we have to students must need to take care. Usually, that in default, if nothing is mentioned, it is actually 365 days that they have to calculate in the US system. But if the question states about this number of days, you can take that as calculation. So the answers is it would never be economically feasible, or $125,000 or above, or any amount greater than $173, or any amount greater than $62,500. So the calculation comes. In this question, we need to compare the cost savings to the cost of the wire transfers. The cost of a wire transfer is $25, and the interest savings will be 0.02% per day. This is the per day's interest, because the interest rate is 7.2% divided by that 360 days. So accordingly, we get per day what is that things. The wire transfer will speed the process by 2 days, so we need to calculate how much money will earn that $25 in interest in 2 days. This is done by dividing that $25 cost by this 2 days. So we get that is equal to $62,500, which is the amount of the deposit that will earn $25 in 2 days. We can check this as follows. So 62,500 and the interest is 4,500 at the rate of given 7.2%, and so the annual interest, whatever that 4,500 divided by 360 days, we get $12.50, that is interest per day, and in 2 days they will receive $25. So any amount greater than 62,500 will be beneficial. Why? Because if you get 62,500, it comes to $25 per day, and even the cost for this also $25, so that there is equilibrium status. So any amount greater than 62,500 will be beneficial. Next question, using a 360-day year, what is the opportunity cost to a buyer of not accepting the terms such that the 3% discount if the payment is made within 10 days, if not then net within 45 days that they have to pay. So for calculating this, for this question, we have this formula to be used. So it has to be 360 days divided by the difference between the period for payment minus the discount period. So that we have to take it, and that has to be multiplied by the discount percent divided by 100 minus the discount percent. So if we apply that, it will calculate to 31.81%. So next question, a firm and entertainment ticketing service is considering the following means of speeding cash flow for the firm. So a lockbox system would cost $25 per month for each of its 170 banks and would result in interest savings of $5,240 per month. So drafts would be used to pay for ticket refunds based on 4,000 refunds per month at a cost of $2 per draft, which would result in interest savings of $6,500 per month. And electronic transfer items over 25,000 would be transferred electronically. It is estimated that 700 items of this type would be made each month at a cost of $18 each, which would result in increased interest earnings of $14,000 per month. So which of the methods of speeding cash flow should the firm adopt? So this is the question. So if you apply the calculation for each options, first let's see this, a lockbox and electronic transfer only option, and for that the lockbox system, the benefit is given that interest savings of $5,240 per month, and for 170 lockbox arrangement, and for each will cost $25. So when you apply that, the cost side $25 multiplied by 170 against the interest saving per month, which is 5,240. So per month saving is 990. And for drafts, it is 6,500 interest saving against the cost of 4,000 draft refunds and 2 per draft. So that is the cost. So the minus $1,500, which is a negative. And so draft system should never be used. So that we conclude that things also. And electronic transfer only, which is given also, that is 14,000 saving per month against the cost of 18 at the cost of 18 each for 700 items. So it will come to $1,400. If we combine all these things as per the question, so lockbox plus electronic transfer, which is getting 990 plus 1,400. That is one of the option, which is lockbox and electronic transfer only, option A, which is getting $2,390. All other options are lesser than, giving benefit lesser than that. The net benefit is lesser than that. So therefore option A is the correct. Thank you. Praise be to God. எல்லா புகழும் இறைவனுக்கே. And we will see in our next class.